Okay, so we're back with the final demonstration problem for this unit, and this is flexible budgeting. All right, so you can see the problem I've put up, and this is the handout I provided as well. You can find that in the unit, but I want to talk a little bit about why we use flexible budgeting. All right, so based on your understanding of the budgeting process thus far, it's based on a static or a fixed amount of units. Now, the problem with that is um, the actual activity could be different, and in most cases, unless you have a crystal ball, will be different. All right. So let me do this. Let's use in this handout. Let's use this budgetary information because we have two pieces of information here. This first piece, these are budgetary numbers. These numbers would have been on hand before you ever entered the period because these are would have been came up to with by the budgetary committee. All right. Now, the actual cost, you fast forward it to the end of the fiscal year, and you have the actual numbers. All right. Now let's ignore the requirements for the time being. So let me set up a report basically comparing the budget to the actual numbers. All right. And we need to compute some of the budgetary stuff because it's presented on a per unit basis. And let's actually start with units. The budget was for 2,000. Actually, you manufactured 1,900. Direct materials. Materials handling. Depreciation. Okay. So let's plug in the budgetary numbers here. All right. So direct materials budget indicates that we're going to use 6 pounds of direct material costing $1.25 per pound, and we're manufacturing 2,000 pounds. All right, so there's where 6 comes from. There's where the $1.25 comes from for 2,000 units. All right, so that's your budget for direct materials. For direct labor, 3/4 of an hour. An hour of labor costs $16. And 2,000 units because the direct labor hour is 3/4 of an hour per unit. All right. And variable overhead will do the same way. 0.75 overhead is applied at the rate of $2.65 per hour, 2,000 units. All right. And as it relates to actuals, we have that information, so we can just drop it in. All right. So we see some differences. We'll call these. All right. We've dealt with that term before. and we'll take the actual from the budget. And let's throw a total column in here as well. All right. So when we have variances, we need to be able to interpret those as favorable or unfavorable. All right. So actually, you manufactured less than the budget as far as units go. Let me put dollar signs here. If you manufacture less, it's going to be an unfavorable variance, right? Direct materials cost less than the budget would indicate, which would be favorable. In fact, all of these variances are favorable, right? Because you spent less than the budget would indicate. So we've created a report, but this report isn't incredibly useful, all right? Because you're comparing a budget, but the budget is based on 2,000 units sold. Well, guess what? The company didn't produce 2,000. They produced 100 less. And you have to think that explains the reason that that the costs are generally lower than the budget would indicate. The problem with this report, however, is that we can't tell how much of this is due to the less volume, the lower volume. You produced 100 units less, and how much of the variance is due to good cost management or even poor cost management. We can't tell, right? Because the actual and the budget are based on two different numbers. All right. So what flexible budgeting is we're using the budgetary assumptions listed here, and we're going to adapt those to the actual level of activity, and then create a report comparing the flexible budget to the actual budget. Let me say that again. We're going to create a report comparing the flexible budget, which we've yet to create, but we will, to the actual results, right? And the variances that we get will tell us, they will provide useful information. I'll expound upon that when we get there. To be clear, this is the static budget. It's based on a single level of output that was determined during the budgetary process. Okay, so let's leave this for a moment and actually let me borrow some of this, and we're going to actually work the problem. All right, so we'll start with our actual numbers, and then we'll insert our flexible budget next to it. Now, the flex budget is based on the actual level of activity. All right, so instead of the 2,000, we're going to change that for the actual level of activity. All right, so In other words, the 6 pounds per unit times $1.25 over 1,900 units. All right. $75, 3/4 of an hour, costing $16 per hour over 1,900 units. All right, the fixed costs are fixed, so we can take those as is. All right. Okay. Let's hold that thought. Okay. Picking back up. So we're going to compute variance. All right. Variance between the flex budget and the actual budget is going to give us useful information, since you have adjusted the budgetary assumptions to the actual level of activity. The variance is here we can call a spending variance, and this tells us whether we spent more or less than the standard would indicate. All right. And so and there would never be a variance for units between the flex and the actual, because by definition you're going to take the actual level and then use it to determine the budgeted the flex budget. All right. So we're going to take actual less the budget. All right. And here, negative numbers are favorable. If you're dealing with cost, it flips if you have a revenue. Some of the problems do have revenues in them, but if you're just dealing with cost, negative numbers are favorable variances, and positive numbers are unfavorable variances. All right, and this is favorable because the budget for 1,900 units is 1,425. All right. Yes, 1,425. You actually spent 13. So with this, we know that either one of two things happens, and this is what we're actually going to figure out in the next unit. Either you use less than 6 pounds per unit of direct material, i.e. you were more efficient, or you got direct materials for less than $1.25, or it could be some combination of both of those. All right, but this is an indication that you did better than the budgetary assumptions as it relates to direct materials. Direct labor, however, is the opposite, and this unfavorable variance is some evidence that either it took longer than 3/4 of an hour to produce each unit, or you paid more than $16 for labor. All right, and again, we'll figure this. We'll learn how to figure exactly what makes up a spending variance in the next unit. This would also be unfavorable, favorable, favorable, favorable. Okay, so that is your flex budget performance report, right? And typically you do need to prepare one of these. Okay, that's it for now.